Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com. Here with a Forex strategy video in which we're going to cover one of the more important fundamental topics in the market right now. And this is both a short-term driver, as we've seen over the past couple of weeks, but also one of the most profound guides for medium-term trends and swings. And that theme specifically is monetary policy. All right, monetary policy in terms of whether we're going to get a taper from the Fed, whether we're going to see a stimulus program from the ECB or the Bank of Japan, whether there's going to be a further rate cut from the ECB and other central banks. All right, these kind of expectations have very significant ramifications when we're pricing in FX exchange rates, because interest rates are essentially the return we can expect on these currency pairs. And we have seen some very tremendous moves in the FX market directly related to this particular theme. I'm sure you saw this remarkable EURUSD drop. I think it's actually a collapse from up here at 138, dropped all the way back down towards 133, 500 pip move in the span of 2 weeks, much of it coming on 1 week, and that was specifically related to the ECB and the expectations of an easing policy that was actually confirmed with a rate cut. All right, I'm sure you saw the significant movement we had in the pound dollar this morning. A big rally for the pound. That's because the Bank of England's quarterly inflation report actually verified for a lot of bulls out there that there's a possibility that the Bank of England may capitulate and actually tighten its monetary policy earlier than was previously expected, or they had previously warned. Or how about the dollar yen? I'm sure you've noticed that it hasn't really broken from this congestion pattern. This is a significant congestion and different pace from what we're used to from a year ago. All right, these comparisons are being made because of the monetary policy expectations of the Bank of Japan. Previously, a year ago from today, we were talking about the possibility of a Bank of Japan stimulus program that would significantly devalue the Japanese yen and drive all these yen crosses higher, and that's exactly what we got. But when we were confirmed on that program, everything that happened subsequent to that has been congestion, right? A change in those expectations. These are very important topics for the establishment of whether we're going to get one currency advancing against another, or we can also look at it as a bigger picture item. We're talking about stimulus in general and what it can actually do for risk trends. So a earlier chart that I showed a couple of weeks ago, this is total stimulus, and in that total stimulus I actually have the Fed, the ECB, the Bank of England, the Bank of Japan, and the People's Bank of China, right, the major central banks, versus the S&P 500, a good measure of risk trends. All right. As the general outlook for stimulus rises, it's being held in place, whether QE3 or whether there's going to be a new LTRO program, as we call it, in the Eurozone, or the Bank of Japan is going to give us more stimulus. As that cumulative group actually grows, and grows at a accelerating pace particularly, you have a support for risk-taking, whether it be in equity markets or whether it be high-yield carry pairs. But I want to take a focus specifically at how we can compare these interest rate expectations, these stimulus or monetary policy expectations, to get a sense of where the currency pairs are going, right, individually. So we start off with the EURUSD, which had that really tremendous drop through this past 2 weeks. And you can see it on this chart going all the way back to the beginning of 2010. This relationship between the ECB balance sheet and the Fed's balance sheet is very important. I have it flipped upside down because as stimulus increases, it actually devalues a currency because its interest rates go down and you essentially flood more of the same asset into the market, and you increase supply without the same level of increase of demand, and that is a reduction in its value. So flipping it upside down, this relationship should hold quite tight. But that has definitely not been the case because the ECB's balance sheet has actually been contracting at a consistent pace because of the banks repaying their loans that they got from the ECB. Yet we haven't seen the EURUSD take off on this move. All right. And it's a really remarkable suggestion that there's some hesitance here, and we might actually see this balance sheet comparison take a very substantial change in the coming months. Why? Because after the rate cut from the ECB, expectations are that there is likely going to be a stimulus program that comes in to back it up, because the structural problems that they are trying to solve are probably not going to be resolved with just a rate cut. All right. And we can see this more in a zoomed-in fashion here with the yield. All right, these are the actual yields from the market, the 3-month LIBOR, and the comparisons line up nicely. All right, obviously you want a higher rate of return, a higher yield, so you go where the higher rate of return is. In fact, you don't actually have a positive yield in favor of the euro yet. The U.S. 3-month LIBOR is still higher than its European counterpart. However, we are seeing something of a rebound. Though, in contrast to the ECB versus the Fed balance sheet comparison, this yield is still very much in favor of the US dollar, and you can see that the euro may have outpaced actual rates of return. So as a comparison to the balance sheets, this is actual market return, and you can see that the favor is still in the dollar. It's still swinging towards the dollar. And we can also look at the interest rate outlook. This is the 12-month interest rate forecast. And I'm sure you've seen we've posted these regularly. This is the Euro USD versus the ECB and Fed 12-month forecast. The Fed's 12-month forecast is better set than its European counterpart. That might be offset a little bit with today's Janet Yellen early release comments ahead of her testimony before Congress, but you can see that this is still favoring the US dollar, and when we zoom in a little bit, you can see that we are definitely off pace here with the interest rate forecast dropping much more aggressively than the Euro USD has. So potentially something to fill in if those Yellen comments don't undermine the Fed's interest rate forecast itself. Now that's the Euro USD. I also want to look at the pound, all right, because the pound in this past session was banking on expectations that the Bank of England would have to forego its forward guidance, which said that they would wait until 2016 to hike rates. The market was projecting that it was probably going to be something more along the lines of 2015. Well, the Bank of England quarterly inflation report suggested that yes, indeed, it could be in 2015. All right, so people were justified for bidding up the British pound, but how far does that actually carry us? Are we going to see much of a follow-through on these assumptions? In other words, are we going to be able to break on the pound dollar out of this larger wedge formation? All right, because we certainly have priced in a lot of interest rate expectations here, and remember, that's still in 2015 that we get the first rate cut or rate hike. All right, so we have the yield here, the actual rate of return. It's still in the pound's favor, and that bias or that premium is rising, though it's still far off of the level that we had back towards the middle of last year. Right? Interest rate forecasts are a little bit more tightly correlated to what we are seeing. You do have an interest rate, 12-month interest rate forecast differential here. We'll likely see the Bank of England 12-month interest rate forecast pick up a little bit, but since this is only 12 months, it's not really going to encompass that 2015 outlook. So we'll see what happens with this particular measure, but you can still see the pound is perhaps running a little bit above what its reasonable expectation should be. I also want to pull in the euro pound. The euro pound has an excellent reflection of the same circumstances. We have the ECB's tremendous drop off because of the rate cut, and then you have the pound's rally just recently because of the BOE quarterly inflation report. Now combined for the euro pound, that leads to some significant volatility, but we also can see here in the interest rate expectations, or sorry, the interest rates, that there is potentially a much more favorable circumstance for the British pound in this relationship. And consider what we're talking about in the ECB forecast. There might be more downside here favoring the British pound, especially if the ECB is going to move to further ease. You can also see in the interest rate forecast that this is potentially supported with the 12-month interest rate forecast differential now at its lowest level in over a year. All right. And of course, I want to talk about the dollar-yen. The dollar-yen, as you see here, versus the Fed and BOJ balance sheet difference, the I flipped it upside down because, as I said, a negative or an increase in the balance sheet is negative for a currency. This has been increasing very aggressively for the U.S. side of things, so it should depreciate the U.S. dollar versus the Japanese yen. Yes, the Japanese policy officials have introduced a massive stimulus program, but it does not yet outpace its Fed counterpart. All right. Now, this is a very interesting circumstance that, yeah, we do have something that can actually pull the dollar-yen down. But the point to take away here is that it's not just about what's going on currently, it's about what expectations can carry. Remember back a year ago, the market started speculating on this QE program, and that it actually had it fulfilled in early April. All right, you didn't have much follow-through on the or yen selling on that confirmation, but the speculation into it was tremendous. We do have speculation of a stimulus program, a second-round stimulus program from the Bank of Japan, looking ahead to next April because of the sales tax hike. We're still early in this theme, and this can carry a lot of weight. The question is, when does this actually influence the market? And to what extent will it influence the market now versus where it was previously when the dollar-yen was just off of record lows? All right. There's a lot of questions here, but this is a great fundamental measure for us. This gives us a lot of what's going on in recent price action. So understanding monetary policy as it pertains to the FX market can be whittled down into pretty simplistic views. The interest rates as they currently stand, because that's our rate of return, but also the interest rate expectations through stimulus or rate cuts or rate hikes. Right? It all batches into one major fundamental theme. And knowing this fundamental theme well can provide you with very clear and straightforward trade setups, both in a short-term capacity as we see these events stir this theme, or seeing medium to long-term trends as we really understand where these considerations are going. Right? Hopefully you can incorporate this into your trading, particularly your fundamental side, going forward. Go trading out there, guys. We'll do another Forex strategy video tomorrow.